I think one of the most interesting things right now going on is that if you look at market pricing, it's expected that the world goes back more or less to pre-pandemic conditions pretty quickly. So inflation in the United States, for example, not going exactly to 2, but close to 2 within a year and a half, 2 years, and that happening with only moderate Fed tightening to get there. And when we look at that set of outcomes, the math just doesn't add up for us. So we think either one of two things or some combination will happen. Either the Fed will have to tighten more than is currently discounted to get inflation to target in a reasonable time frame, or it will have to acquiesce and accept inflation that's higher and stickier for longer. And we don't know exactly how much of each we're going to get, so we're positioning for both. So the opportunity we're trying to position for is higher inflation than what's priced, and so we're doing that, to your earlier point, through a number of inflation-sensitive assets, whether we're talking about a diversified basket of commodities, producers of commodities, those currency markets, something like the Canadian dollar or the Norwegian crown. And then on the other side, if the Fed could tighten more than expected, we've been positioning for higher rates along the curve for the last almost year now, but increasingly more on the long end. And also finding some differential opportunities between markets as those conditions differ a lot between countries. I think it's an interesting comment on demographics, which clearly over the long term is deflationary. I think one could argue how much of that is already known and discounted or not. But when I look at the geopolitics today, I would suggest that they're much more inflationary than deflationary, or maybe stagflationary. I mean, Russia-Ukraine is a supply shock. That's happening after we already had a demand shock. And the demand shock was caused by the policy response to the pandemic, which left households and businesses wealthier with higher savings, with more ability to spend, and they went out and spent. And we didn't have enough capacity to meet the demand in houses, in labor, in inventories, in commodities. And now Russia-Ukraine on top of that, which is mainly a commodity supply shock, is exacerbating that inflation pressure that already existed before Russia-Ukraine. And to fix that isn't something, I agree with you, it's time, but I think there's a lot more time needed than maybe most people appreciate. You can't suddenly get natural gas to Europe from the United States without first building gasification and decasification plants, rerouting pipes. These are things that are going to take years, not months or quarters. The labor supply in the US, yes, we're getting some labor supply back, but we still have 50% of companies, based on the latest surveys, 50% of companies in America can't find the labor they need. They have to resolve that with higher wages. Housing supply, our inventories today are at the lowest they've been in decades, and you can't get the materials or the labor to build them quickly. That's going to take years, and in the interim, as mortgage rates go up, you can't buy, so you rent, so the rents go up. And the supply chains, I agree, they will sort out with time, but China's COVID situation prolongs that period. So I agree, it's a matter of time, but when I look at that timing and I take the biggest, stickiest components of inflation in the United States today, I think those things are going to be with us, again, longer than people appreciate, longer than what's currently discounted in the market. So I look at the geopolitical risk at the margin as more inflationary than deflationary, at least over the next several quarters. I think if there was one thing I'd love to leave you all with today, it's to understand that the pandemic, and probably to a degree Russia-Ukraine, has served as an inflection point, and we've moved into a new regime. And that catalyst wasn't the pandemic itself as much as the policy response, both the magnitude of the response, but also the details of the response. Again, primarily just this wall of money that went directly to households and corporates and left them in a stronger position coming out of the recession than when they went in it, which is not something you normally see, at least we've seen in the last several decades. And so what that means is today and looking forward, the things you've assumed for the last 30 years no longer hold true, or at a minimum are at a lot of risk of not holding true. So over the last 30 years, inflation was low and stable. It was changes in growth that drove changes in asset prices. Today, you need to flip that upside down. Inflation is going to be the more important variable. If we're right, core inflation is at 6% in 12 months' time. If we're wrong, it's still going to be the change in inflation that's going to be the bigger variable driving things. And tied to that, if inflation is the bigger variable, then having bonds as your diversifying asset in your portfolio might not get you the balance you need. So you need to think about, if we're in an inflation or stagflationary environment, how do I get balance? And then I'm going to agree with you that having diversified inflation-sensitive exposure, be it commodities or inflation-sensitive equities that'll benefit from that, there's a lot of ways to get there, is going to be a better source of balance today. And most investors don't have that yet. They're missing that and they're exposed. And then finally, over the last 30 years, because you've been in this secular declining interest rate environment, longer duration cash flows looked fabulous, and money has moved into the US. I think today you have to have more geographic diversification. You can't count on the US being that sole engine of growth. I agree that the consumer in the US today is fairly strong. We are looking for real GDP growth to stall out by the end of this year, but largely that's a function of inflation versus nominal growth, not necessarily the consumer retrenching. But I think we're in a position where you could have financial assets underperforming the real economy. And so if bonds aren't helping you, stocks aren't helping you, you need to be staring at your portfolios and thinking, where do I get balance? Where do I find safety? It might not be the same place it's been in recent decades. You need to go back further in time to think through the playbook.